David R. Guttery is the president of Keystone Financial Services in Trussville, Alabama. David Guttery is a financial advisor who represents Emeritus Investment Company, LLC, and Emeritus Advisory Services. Please stay tuned through the end of the video for additional important disclosure information.
Hello everyone, I'm joined today by David Guttery, president of Keystone Financial Group here in Trussville, to continue from last month's video on whether or not equity markets may be trying to find a bottom. David, thanks so much for joining us today. Well, last month you suggested that markets may be coalescing around a bottom, and you offered some data to support your position. 30 days later, and it appears that many of your statements and assumptions are coming to fruition.
30 days ago, and 2 weeks before the last Fed meeting, I suggested to your viewers that I believed the Federal Reserve would find itself with latitude to just simply blink, not pivot, not pause, and certainly not cut, but rather to be less hawkish with what remains of their strategy for tightening. And indeed, this is what Chairman Powell indicated in his post-meeting press conference and also reiterated in the release of the minutes from the meeting. I believe that global markets have overly priced the thought of a blindly hawkish central bank into nefarious assumptions regarding the potential for a deep and long recession. Within this image, you get a sense for why global markets may have been left with this assumption. Until recently, it seemed that 90% of the world's central banks were following the same patterns of tightening, and the assumption was that this would continue without regard for economic deceleration. Remember last month I said that in my opinion, the Federal Reserve is not trying to control inflation. Nothing about the previous 75 basis point rate hikes has had a material impact on the cost of living. And you can argue that it's made the cost of shelter even higher. The Federal Reserve is trying to disincentivize lending and borrowing, and over time, this will have a muted impact on inflation. We've heard since birth that inflation is too many dollars chasing too few goods. The Fed is trying to create an environment of fewer dollars chasing as many goods. If they're not careful, in the process of disincentivizing lending and borrowing, they might disincentivize production as well, which would leave us in an environment where we have fewer dollars chasing fewer goods. That is the definition of stagflation, and the Fed is trying to avoid this. So let me give you a really high-level example of what I mean by this. I'm an entrepreneur, and I want to manufacture this pen and bring it to market. I must determine the amount of money that I need to borrow to build the plant, to buy the capital equipment, hire the people to run the machines with the materials that I need to purchase to manufacture and distribute 1 million units at $1.50 each in order to realize an internal rate of return of 8%. Then the Federal Reserve changes the equation by raising my cost of capital from 2% to 7%. Well, now I have to rework my assumptions and then realize that I must either raise the selling price of this pen to $2.25, at which point I may not sell 1 million units, or keep the price at $1.50 and be happy with a new internal rate of return of 2%. The Fed just disincentivized me from borrowing. They are also disincentivizing banks from making new loans. There are fewer dollars in the lendable supply, and as such, each new subsequent loan is made with greater risk if there are fewer dollars to lend. Lending restrictions are increasing relative to where they were in November of last year when tapering began. So the Fed isn't directly trying to control inflation, but rather control the supply and the velocity of money, which over time should have a negative impact on inflation. I thought the idea of a haphazard Federal Reserve tightening without regard for economic impact was absurd, and thus why I believed that they would find latitude to be more gradual with pursuing targets of tightening. 30 days later, anyway, it would appear that this was a correct assumption.
Well, David, can you help our viewers understand why this outcome has seemingly been a positive for the markets lately?
Absolutely. In last month's video, I also suggested that if indeed the Fed were inclined to be more judicious with pursuing targets of tightening, that among other things, we may well find ourselves with the dollar showing weakness at a time when it had been unusually strong. Indeed, on Friday, the 4th of November, following the conclusion of the Fed's meeting on Wednesday the 2nd, the dollar index had its worst day since December of 2015. Well, if a stronger dollar has caused the markets to negatively reprice the risk of lower revenues resulting from products being purchased with weaker foreign currencies, then I thought the opposite would be a positive catalyst if the dollar relented from historically high levels of strength. In my opinion, that seems to be playing out now. In our last video, I drew reference to a graphic that juxtaposed the current cycle of tightening against other major cycles of tightening seen over the last 35 years. Clearly, this cycle is the most restrictive that we've seen over the last 3.5 decades. Because of that, we have areas in the economy that are showing significant weakness. Mortgage rates are over 7% for a 30-year amortizing mortgage, according to Fannie Mae, and this is up from 2.5% in February. Rising bond yields that have resulted from the Federal Reserve unwinding its balance sheet have caused these mortgage rates to rise. This cycle of tightening appears to have begun just as real estate was peaking, and we can see the visceral response since establishing that peak. The assumption that the Federal Reserve wasn't cognizant of such metrics as they pursued targets of tightening was just not justifiable in my mind. A less hawkish policy stance may cause negative trends in housing, for example, to ease as well, and therefore cause the markets to reprice the risk that maybe previous assumptions were wrong. Housing is just one major economic area where we can see the impact of Fed policy. As for the manufacturing side of the economy, we are a gnat's eyelash away from contraction territory. As for the services side of the economy, we're slightly higher above the expansion and contraction line, but the rate of declination appears to be even more steep. I could give you many examples of metrics citing economic deterioration. These are just three of the more important macroeconomic metrics. For this question, though, a less hawkish Fed signals to the market that it is indeed aware of the degree by which the economy is struggling to expand, or by which it is contracting, and because I believe the Fed wishes to avoid stagflation, I believe such data will weigh heavily on future actions by the Federal Reserve, and the market is reacting positively to this development.
Well, David, in our last video, you mentioned that we were beginning to see evidence of what you called capitulation, and then we really didn't have this evidence over the summer during that bear market rally. What are you seeing now that causes you to believe that this bottoming process may be real?
In our video from last month, you'll remember that I drew reference to a chart that depicts emotional states of being across economic cycles. I suggested then that I thought we were drawing near to the capitulation phase, and 30 days later, I believe we have increasingly greater quantifiable evidence that suggests this may be the case. All of this is important because if we are indeed coalescing around a bottom and you're not in the market, then in my opinion, you run an even greater risk that comes with talking yourself out of participating in the recovery when it occurs. So what quantifiable data do we have today that wasn't so clear 30 days ago? In last month's video, we talked about stochastics and how this, at a high level, is the art of observing patterns of behavior, connecting those dots to form patterns or Bollinger Bands from which insight may be gleaned. So let's take a stochastic look at the market. I didn't draw this chart. The market participants drew this chart with their actions. You're looking at the same data expressed in two different ways. The top chart reflects rolling, smoothed periods of time for relativity. The bottom chart is a linear depiction of the same data. At the bottom of the chart, it appears that we have bounced off of the same Bollinger Band 4 times in February, May, July, and again in September. This is where markets are telling you that it collectively feels that risk is adequately priced at these levels. If you see a double bottom, it's encouraging. A triple bottom is exciting. If you see a quadruple bottom, pay attention. As we've previously discussed, however, I've had the feeling lately that the world had collectively priced more risk into market valuations than was rational. I believe the markets had priced into themselves a long and deep recession caused by global central banks blind to economic impact of their actions. If this is indeed the case, then I have to ask, as we bounce from the same Bollinger Band for a fourth time, how would markets react positively? How might they retrace these losses if indeed reality turned out to be different from those assumptions, and hence why the Fed was a critical piece to that puzzle just a few weeks ago? We also looked at this graphic that seems to suggest that this is one of the worst bear markets, if not the worst bear market, 176 days into the cycle that we've seen since 1929. Now, in and of itself, this is not an actionable piece of data, but when viewed collectively, with evidence of a weakening dollar from record strength, and seemingly holding the same line of support on 4 occasions this year, and when we are relative to all bear markets, you start to get the sense that maybe markets have overly priced nefarious assumptions into themselves. So now we start to look for evidence of capitulation. To me, this is evidence of the average investor just wringing their hands and metaphorically saying, "I'm done. Lock in the losses. Get me out." Well, I believe we had that in September. Now, this chart is a little busy, but what it depicts is the amount of fear that was priced into the month of September. The open put to call ratio hit its highest point for the year, and a high not seen since the economy shut down over COVID in early 2020. Below that, you see the bull-bear ratio at a low point in September, not seen previously since 2008 and the Great Recession. We didn't have this in July. Furthermore, mutual fund outflows spiked sharply in September, which is usually a characteristic of the capitulation that we've talked so much about. By the end of September, only 3% of the S&P 500 was trading above its 50-day moving average. So let's recap. We bounced off the same Bollinger Band for a fourth time. As the open put to call ratio was setting its high for the year and bearish sentiment was thicker than at any other point since 2008, with a spike in mutual fund outflows and with near record dollar strength causing the markets to reprice risk of repatriating dollars, producing lower than expected revenues. This is why you never want to give in to capitulation compulsion. If you did at the end of September, then you likely missed the best month of October that we've seen in 45 years. For context, I was in the 2nd grade the last time we had a month of October that was this positive. So in conclusion, regardless of the period of time or the state of the economy, the achievement of long-term goals is predicate on the consistency with which you meet the implementation of the strategy. The composition of the investments account will change to reflect current periods of time, but the approach, the dedication, and the commitment to the strategy should be unwavering. Even missing a few years with the thought of letting volatile periods of time pass you by can have a detrimental impact 40 years down the road on the potential success of long-term plans. I get it. I know that everyone is weary of this strange and really unique year, but I believe that we've seen a point of inflection. And now is the time to have conviction and intestinal fortitude to continue working through periods of time such as this and avoid the risk that comes with riding the emotional roller coaster.
Well, David, as always, thanks so much for this useful information. And for additional information, David may be reached through the means listed upon the following screen. For the Trustful Tribune, I'm Brannon Dawkins.
David Guttery independently offers securities and investment advisory services through Ameritas Investment Company, LLC, member FINRA, SIPC, and Ameritas Advisory Services. Information provided in today's segment is gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed and should not be interpreted as tax or legal advice. Any performance stated is past performance and is not indicative of future results.